So today we're going to talk about more different types of loan programs. And I brought on a friend of mine, Melanie Galvin, who is a lender at Fairway Independent Mortgage. And you've been doing this for how long?
Yeah, over 20 years.
20 years. So when we talk about these type of topics, again, we're talking about where we've seen the good, the bad, the ugly. We saw the Great Recession in 07, 8, 9. And so we wanted to talk about some ideas and some loan programs that people might be interested in or unaware of in the current climate. Because I know with people having so many homeowners either owning their home free and clear, or I think when I did my little research, it was 62% of people have mortgages at 4% or under. What would cause people to want to turn around and put their home up for sale when rates, when we talked, the time we're shooting this video, we're in the 8%. It's just really interesting times right now as that real estate pie has gotten a lot smaller. So first things first, let's talk about what we just mentioned, where people that have either, like for me, I have a 2.875% interest rate, or lots of people that have in the 3s and 4s. What are some things that you're seeing that might want to make somebody maybe put their home up for sale and move forward?
I think a lot of it is perspective. One thing that people forget about is their revolving debt. So when we're talking about your interest rate being at 2.875, that's awesome. Like, no one wants to get rid of that. Right. However, if they have revolving debt that rolls over every month, you're looking at, 28% interest rate. So their average interest rate that they're paying is well over 8 when you average it all out. What I like to do is take a deep dive, a deep look into what their overall debt scenario looks like and analyze that and see if it makes sense for them. Because if they did choose to do a cash out refinance right now, they could ultimately be paying less. And the same goes for a purchase. If they're worried about making a purchase because of their interest rate that they're so in love with, they could end up selling their home, paying off their debt, and still ultimately paying less out of pocket every month.
So whether I do a second loan or refinance my whole loan, if they're pulling cash out, is that much more expensive to do than if they're just getting a loan to go buy a house?
It's actually cheaper.
Cheaper.
Yeah, could be much cheaper for them.
And is the process similar for them?
It is. Depending on the loan that we're doing, it is similar. We still normally collect the same amount of documentation. Some loans are less, which is nice if you're doing a standalone HELOC or HELoan type of second to take over that debt and eliminate that. Plus, you get the added benefit of writing that interest off, whereas you don't get to do that if you're making your credit card payment every month.
So people should definitely reach out if they have all sorts of other high interest debts, whether it's student loans, car loans, credit card loans, some other weird loan that they may or may not have, and hopefully they can get all that paid off. And even though your house interest rate might dramatically change, your overall monthly payment for all these things might be in a much better situation.
Very true. And if people chose to sell their home, pay off their debt, and wanted to have the same out of pocket every month, they could end up paying down their mortgage quicker too.
Right. I tell people, be really careful with that, because you don't want to take too much of the equity out of your house to sort of pay off debt, where sometimes some of those things are, I want them to learn the lesson that they're paying this high interest stuff. And so they just have to be careful with that kind of situation.
Money management.
100%. And I know both of us talk to people and coach them up more than that. I try to always be more of just, we're not here just to help you buy and sell homes. We're here to help you build up wealth and figure out ways to maybe be better and smarter with your finances. We get this question all the time where we have lots of people obviously that own homes with lots of equity and low interest rates, and they want to go out and buy another house. You have these people that are trying to figure out, I don't want to be contingent on the sale of one house in order to buy another house. And so what are some things that you guys have that might help somebody with that type of situation?
So we have what we call a cross collateral loan, kind of like a hybrid bridge loan, if you're familiar with that term.
Right.
However, we don't need to take into consideration the liabilities that are part of the departing resident. So the home that you're wanting to sell at some point in time. The beauty of it is you could potentially make 100% offer with limited out-of-pocket cash with your closing costs, depending on how much equity that you have in your current home. And the beautiful part of that is if you do sell your home and you want to recast your mortgage payment, you can do that and we'll reduce your rate by a quarter.
All right. So she mentioned recasting loans. We're going to talk about that in a minute. There was another loan program you talked to me about locking it and listing it. And I had never heard of this before. So why don't you just tell people what that one was?
Yeah, we've been a very high, quickly paced, rising interest rate environment. This is really great for the seller to protect the interest rate for the buyer. So they can actually pay a fee. It's $1,500, protect the buyer's interest rate. We call it lock it and list it.
Okay.
Your seller would essentially be working with me as a potential lender for your buyer to get a lower interest rate.
So at the time of this, if let's say interest rates were 8% and I was a seller, I wanted to call you, and for $1,500 I can lock in at 8%, or would it be lower than 8%?
The seller has to buy it down 2 points in cost. In and it's going to vary because they don't know what the buyer is going to look like. So if you're looking at a $300,000 loan, that's $6,000 that they would be contributing towards the buy down.
So it's sort of like when we see offers come in, sometimes represent sellers, and they're asking for closing cost credits from the seller. And so it's sort of a way to sort of almost pre-do the 2-1 buy down ahead of time.
It is, except it's a permanent buy down. One thing that I love about, there's 3 2-1 buy downs, 2-1 1-0s. One thing that I love about that is because it's a little bit less of a shock to a buyer for a payment with an interest rate. If a seller is going to give a credit, is to take that money and let the buyer decide, do they want the temporary buy down? Do they want a permanent buy down? Do they want to buy out their MI if they're putting 10% down on a conventional loan? So lots of opportunities for people to be able to take advantage of. You just need to be connected with somebody who can help with strategy.
Well, I keep explaining that to people. Like right now in our market, let's say in the last 12 to 18 months, prices have come down, I say 12 or 10%. And they're probably going to come down a little bit more through the winter, but not dramatically. But there are lots of options and lots of loan programs that people are completely unaware of. And I didn't realize that, the 2-1 buy down or 3-2-1 buy downs that you've been hearing about, obviously we all know those are temporary. But if you're able to then do a permanent rate buy down, instead of getting the house for $10,000 or $15,000 cheaper, but you can have that rate be permanently cheaper, to me that's a much better way to go, because you're seeing people saying, buy now, the rates are high, and sometime next year rates will come down and we can refinance. And if rates do come down, I always say those prices are going to go back up. But if you can win on both fronts right now, get a permanent low rate and a price that you're happy with, I think that's an amazing thing. So something you mentioned earlier, and we had talked about this, and I want people to understand because I'm starting to see content and videos about recasting your loan. What are we talking about when someone's trying to recast their loan?
When somebody wants to recast their loan, if let's just say their mortgage is $750,000, they sold their home for $5,000, they're going to use $300,000 of that to recast their loan, which means they're going to pay down their principal, and it gives them the opportunity to also reduce their payment. So nothing else changes except for your payment. Your interest rate is still the same. The mortgage balance gets reduced, of course. So now you're at a $450,000 payment on the interest rate that you locked in with your lender. If you paid that mortgage for a year, 2 years, 3 years, you're still going to be and have that 27-year time frame to pay it off, but you get a reduced payment, which is awesome. You pay a nominal fee. Let's say it's $250. When you're working with your lender, you want to make sure that the servicer will allow the recast, because some servicers do not.
I talk about how there's ways to take a 30-year mortgage and make it paid off a lot faster by just paying extra to your principal. But if people just pay extra to their principal, your monthly payment stays the same.
Correct.
Recasting basically makes your time frame all stay the same, but you can actually then make your monthly payment a lot smaller by, of course, reducing that loan balance. So one other thing that I think there's still a lot of confusion out there with is people feel like, hey, I've got to put 20% or big down payments down on properties. I think people need to understand that as much as, if you put 20% down, you don't have to pay PMI. PMI is not that expensive. And sometimes waiting to get a big enough down payment is way worse than just saying, I'm just going to pay PMI for a while. Yeah. And you can eventually get your PMI waived as your equity balance increases and you get, more of that 80-20, loan to value thing going on. So how much do typically people expect to pay for some sort of PMI?
Now, if you're doing a government loan, FHA, USDA, those are set in stone. So you're looking at it's based off of a factor. MI on a conventional loan is risk-based, like an interest rate. So, those things that come into play, what's your credit score? How much money are you putting down? Is this a primary residence? All those things come into play, a condominium, a manufactured home, etc. So we call those risk factors in our industry, or loan level price adjustments, for someone who is in the industry who knows what those are. So instead of coming in with 20% down, paying the MI at a 10% down is much cheaper. You keep way more money in your pocket. You pay that MI for 2 years. The cheapest way for you to get that MI removed is to call your servicer and ask them if they will remove it. It's way cheaper than doing a refinance. And if they come back and say, no, that's okay, we can refinance you. It's a great way for people to have their MI removed on their conventional loans.
Yeah, I've had plenty of people call me over the years. So they want to make sure they feel like, do I have enough equity in my house to even waste the time of paying for the appraisal or doing it to make sure there's enough room in there? But I never knew quite how they figured out. But I guess like anything else, those PMI numbers are just always like the same thing, no different on the interest rate or all those kind of things.
Yeah, on a conventional loan, it is like an interest rate where those risk-based factors come into play. But on an FHA loan, for example, it can change depending on how much you are putting down. It would be reduced mortgage insurance, but it's based off of a factor on the government stuff.
Well, I appreciate that. Hopefully people that are watching today maybe heard some terms and some things they've never heard before, or some loan programs they weren't aware that even existed. So if you're someone out there that owns a home and you're on a really low interest rate, or maybe have all sorts of other debts and you're not quite sure what you want to do on a much bigger financial picture than just helping people buy and sell homes or investing in real estate, there's lots of things realtors and lenders and people like us can do for them. So if you have questions about this, by all means, please DM us, send us information below. I can get in touch with Melanie. We're happy to see what we can do for you guys. And again, we appreciate you watching the video. Subscribe to the channel if you're enjoying the content we're putting out there. Send us the messages. We'll see you on the next video, and thanks for watching. Have a great day.